now joining us to look at, or to rather get some investment insight on how scenario planning can affect your portfolio. Herman Steyn, Chairman of Prescient Investment Management, joining me in studio. Herman, you've obviously spent some time with the great Clem Sunter, of course, is a scenario planner, and he's looked into his glass ball and helped you come up with various scenarios and how that might affect various types of portfolios. So let's run through some of the scenarios that he's put on the table firstly, and then we'll go into the performance of various assets if these scenarios pan out. Firstly, looking at the one scenario, extension of hard times. Well, what does that scenario mean for assets?
That really means business as it's been for the last number of years, where what we call the old world doesn't grow. They keep interest rates low, and we see pretty much the same as what we've seen the last few years since 2008. And the new world, Asia, Africa, and maybe South America, has a better chance of growing, driving their own domestic demand.
And then we move on to a situation where you've got ultraviolet, where you've got the old world with a big U around it, and V for victory, I assume, for the new world.
It really just means the Europe specifically won't recover in the near term. So it'll move sideways for a long time and then later recover. That's the U, where the recovery in the new world is quite quick. So it's a V. We should be in that recovery phase if that scenario is going to come true.
So what scenario between the two right now? Are we looking at the ultraviolet scenario being the one that is more probable right now?
Well, we try not to put probabilities on that, so I'll give you Clem Sunter's probabilities. It's about 40% for the UV and about 50% for the same as we've seen.
Okay, so he's pretty much brave enough to go there because, of course, there's just so much uncertainty as to how European leaders are going to deal with this right now. You're looking at the situation getting a lot worse. The next one is called New Balls, Please, and that's as in Bernanke, please help us out and give us more money, print more money.
That is when we, and I think the rest of the world is wrong and Bernanke is right, and that the lower interest rates actually lead to world growth. So that's the most bullish scenario. And so what we'll see is that interest rates stay low in the States, growth comes through, China grows fantastically and matches the West in a number of years. So that's a very strong growth scenario.
And then, of course, forked lightning. And a default is something that you're looking at here, and that's a situation where you've got equities being hard hit across the board.
Well, in that scenario, we have a default in Europe, a large default, not Greece. Greece is quite small, so that's not a real concern to us, but something more like Italy. And in an environment like that, you will see sort of a tsunami of defaults going across Europe and America. And we must realize that America's got greater debt as percent of GDP than Greece has, so they're in deeper trouble.
Yeah, that is something that we have to start worrying about as we enter the new year in 2013 with a new president, possibly in the United States.
You might find a new president.
Possibly.
Possibly, yes.
Yeah.
And so that is a bit of an outlier scenario, because we don't believe the central banks will let there be such a big default. But it is a possibility, and at least you have to consider that scenario in the case where it looks like a default, the old world starts stagnating again like it did in 2008 and 2009.
Okay, so we've got these various possibilities panning out right now. The one is that interest rates do help spur, low interest rates do help spur growth going forward. The other is that we've got a sharp rise in growth coming from emerging markets. And then the other one is that we really stay in the situation where we are right now with just this kind of lingering and subdued economic growth. Within all of this, how are you positioning, what are your thoughts on asset allocation? And just take us through bonds, emerging market equities versus developed equities.
Yeah, if you have a scenario, it's like New Balls, Please, that is where we would see all markets performing well. We do believe that the new world will outperform still, because in a growth scenario you will have resources being in big demand, and then we supply resources, Africa supplies resources. So that will be where the most growth is. You will, in an environment where China grows as strong as that, matching maybe the per capita income in a number of years of America, you just don't have enough resources. That's a very bullish scenario for our share market.
So very bullish. I mean, looking at your forecast, emerging market equities would rally by some 20%. Correct. Under that, you've got emerging market bonds performing by a 7% return there, and that would be in line with inflation. So I'm assuming under that scenario, it's better to put your money into equities. Yes. If you have that view that low interest rates are going to spur growth.
Yes, it is the growth scenario, and you should be in equities.
Yeah.
So if you positive about that growth, you should be in a fund that's either fully equity or a balanced fund where the fund manager decides on the allocation of equities. So some kind of balanced fund.
What type of view should we be taking on China within all of this? Because there are a lot of concerns right now around how China is managing, how China has managed to grow its economy and manage the enormous growth it's had. And of course the slowing down that we see in the World Bank cutting its forecast for growth this year to 8.2%. What are your views on China right now?
I think people don't understand growth numbers. If you take something like China that grows at 10% for 7 years, it doubles its asset base from where it was 7 years ago.
Yeah.
So if it now grows at 5%, it's still adding as much value as it did 7 years ago. So 5% is still a fantastic growth rate. So this compound interest would work in its favor. So we don't see 5% as an issue. The issue is if China actually stops growing. It goes back to zero.
Well, it doesn't look like that's going to be a probability.
No, I don't think
so
it's
what is there an issue with China from your perspective right now?
I think there are issues. They've got massive oversupply of housing in second-rate cities, or second-tier cities, I would rather say. The smaller ones that we don't know about that only have 10 to 15 million people living in it. So that's quite a big oversupply. But the share market is quite cheap compared to where it was trading earlier at about 40 PEs. It's now at PEs, depending on which sector you look at, about 15 PE. So that's taken some of that into account already.
Are you increasing your exposure to China or Asia?
Yes, we've just been given a license to operate in China, what they call a QFI license, Qualified Foreign Institutional Investor license, the only institution in Africa that has one. So yes, we will be increasing our exposure to China.
Okay, so let's look at Africa as well, because looking at your forecast, not as bullish on Nigeria as many others in terms of where Nigeria's economy is going to be by 2017 versus where it is now.
I think we are bullish about Nigeria. It's just it's difficult to know exactly how fast they're going to grow. It's a very cash-based kind of industry. They're changing. They're becoming more structured in the way they operate. So I think we will see strong growth in Nigeria. And specifically if we see oil prices kicking up. In some of the scenarios, oil prices could rally to well over the prices they are at the highest.
In what scenario over here?
Well, new balls, please. And the consensus is that the oil could go to $200-300 a barrel. So,
what about currencies right now? Because looking at your forecast, you're looking at a rand-dollar exchange rate of 7 rand 60 to 7 rand in the new balls, please, and that's the low interest rate environment spurring growth scenario. In the forked lightning, where we have a massive default in Europe, you're looking at the rand blowing up to 10 rand 50. How do you play the currency market right now?
Well, there are two aspects to the currency in that environment. The one is that remember the dollar-euro was 160 at the high. It's now sort of in the mid-120s. So in that scenario where there's a blow-off due to a default in Europe, we see it going to parity, 1-to-1. So that's the first thing. The second one is that we've had massive purchases of bonds over the last number of years in South Africa due to our higher interest rates. So there's a big overhang of foreign ownership, and they own about 40% of the JSE. So if that goes wrong and they need to take all their money back home, we'll see a sell-off.
It's a big risk.
Yeah.
Either way, though, where do you stand right now on exposure to South African assets versus dollar assets, euro assets, and then perhaps yen, China? You know, Juan, we also need to be asking those questions.
If you take our best view, take a balanced fund where we exercise our best view. We've got about 60% in South African equities, about 9% in African equities, about 8% in gold, being the resources play, and then the money we have in Europe is underweight what you'll expect at 25, so it's more in the region of 10, and it is in a low volatility balanced fund in Europe, trying to take advantage of equity markets that go up but very well protected. So I think that is our sort of best view.
Thank you so much for joining us and sharing some of your insights into the likely outcome of all the uncertainty right now and how to plan your investments. Herman Steyn, Chairman of Prescient Investment Management.